Hi and welcome to On the Record, your playbook for tapping India. Today we will look at an interesting topic called transfer pricing. So this is applicable to every business who is doing transactions with related party. Now what is a related party? A related party could be a direct subsidiary of yours, or it could be another company in which you have a decent amount of control or influence in governing their decisions, or it could be another company which is owned by you or any of your close relatives. So these are called related party transactions, and any related party transaction is up for transfer pricing. So in a very simple words, if I have to say, transfer pricing is about having a fair pricing. So imagine this, if you are working with a vendor, you would be paying a certain amount of money for the services or goods that you are taking from them. But if it is from a related party, the chances are high that you could buy them for lower than the market price. So the idea is, in this case, there is a profit which is being shifted. Now the profit could be shifted to a lower tax jurisdiction, or it could shift to a different geography where the government ends up losing a lot on taxes, and that's why they have implemented this concept of transfer pricing. So the idea here is to see that whatever transactions you are doing follows the principles of arm's length. That means if there would have been a third party vendor instead of your own related party, the pricing and the transactions is done at a fair market value or a similar price range. Now what does this means for you? So for example, if you are having a subsidiary in India, it is quite possible that you can only bill to the parent or the US company the amount of expense that you do in India. So that means if you have spent say $100,000 in India as your cost, you will only bring that much money to India, and not just today, lifelong you will never end up paying a corporate tax in India. So that is a pure loss to the Indian government. So it is not just an Indian concept. Transfer pricing is available across the globe. Majority of the developed nations have some variations to it, and that's also called transfer pricing, something similar in the structure or rules. So coming back to our example, if you spent here $100,000 and you are bringing only $100,000, there is no profit in the India entity ever. So you will end up paying a zero tax. Now you can always argue that you are creating jobs and you are generating employment in India, but that is just one aspect of it. As a business, you should also be paying a corporate tax in India. So this is the reason why government mandates that you should have some markup to the services or the expenses that you are incurring in India. So for example, if you would have had a third party solution provider, you would have been ending up paying a higher amount to them rather than purely at cost. That's why proper transfer pricing study needs to be conducted to arrive at what is that justified percentage of markup, and this studies tries to derive what others in the industry are following. So based on your domain, what are the other competitors, the companies of your size and stature, the kind of technology you are working on. So it's a complex set of studies which helps you to derive at whatever is the right markup that you should bring to India, and that markup becomes your profit in India, and you end up paying a corporate tax on that. Now this study is mandatory if you have crossed a certain threshold, which is currently INR 1 crore of turnover in India. I am saying turnover of India. Turnover is your billing from India. But before that, it is not mandatory. The government also specifies few percentage markups based on your industry, which is called safe harbor rules. So you have a choice of either using that and pay or bring a markup based on those percentages and then end up paying a tax into India. Or if you have done a fair study which should be justifiable, again the study is up for challenge. So you should hire a good expert to conduct this study, and based on whatever is the recommended markup comes, you should be billing the parent entity accordingly. Many times it is also advisable to enter into something called advanced pricing arrangement with the government of India or the tax authorities. What this means is, instead of the tax authorities coming and questioning you, that this is not the right markup that you have been following and this is what it should be, and then they levy interest and penalties from the retrospective date, assuming the new markup, it is a good idea that you go and reach out to the tax authorities, tell them that this is what you plan to do and this is what is justifiable. And if they are convinced, they would be okay to enter into an APA with you, where for the next 5 years you can follow the same markups and then again revisit this and see what makes sense going forward. So that's broadly about transfer pricing. Now the question arises, what happens to the excess cash? So for example, say 100,000 was your expense in India, and this expense is inclusive of everything. So that means the salaries, the rents, the local expenses that you do, the compliance cost, the internet, any travel, everything comes into it. Only the CapEx. So for example, if you have bought a laptop, the whole amount of laptop would not be part of this. The depreciation on the laptop would form the part of 100K example that we are talking of. So all the OPEX will include into 100K. So you end up say 15%, which is the most common markup for most of the tech companies. So you would actually get $115,000 from US to India. Now $15,000 is your profit. So you will end up paying a tax on it. Assuming about $4,000 to $5,000 goes into taxes, you are still left with about $10,000 as cash. And this cash you will keep accumulating every month, because say 100,000 is your billing or expense in India every month. So every month you will get $10,000 extra in India even after paying tax. Now what can you do with this? There are two things that you can do. One, you can use this extra cash for your CapEx. So for example, to buy a laptop, you need say about $2,000, but the depreciation could be just $300. So you still need that $1,400-1,500 extra to buy the laptop. So this cash can be used to do any kind of CapEx. The second thing, even after all your CapEx expenses, you have left with cash. Then if you have a subsidiary, you can actually pay back the extra amount as dividend back to the parent entity. Now there are other formalities that you have to do around distributing dividend. You have to also withhold taxes, but that's not the topic of this video. So, but that is the another use of cash that you can do. To sum up, all I can say is, if you are having a subsidiary, it cannot be in loss right from day one. So you should have a profit. You should keep paying corporate tax around it. So transfer pricing is an important piece. Before you start operating in India, you should understand this principle and see how it could impact your cash flows and other corporate tax structures. That's it in this. Thank you and take care.